everyone. Thank you so much for joining us for our special presentation today on enhanced Roth conversions with Matt Chancey. I'm going to turn the webinar over to him in just a second, but I'm going to introduce myself and talk about Advanta for a few minutes. I do see we have people logging on as I speak, so I just want to let everyone know that I do keep the webinar muted. It just keeps it nice and clean, but if you have questions, we are going to take questions throughout the webinar. So go ahead and type them into the question box, and as we go, we will get your questions answered. My name is Larissa. I'm with Advanta IRA, and I've been with Advanta for 8 years now. I do marketing, education, and sales, and I've been doing that, or I've been in this position pretty much for most of my time at Advanta, about 6 years. Prior to doing this type of work, I also did back office work, so anything that the office needed, I've been exposed to, including things like check writing on behalf of IRAs, accepting payments. I've opened new accounts, I've done transactions, so I'm very familiar with the self-directed IRA platform and how it works. And so I want to tell you a little bit about Advanta, and then I'll bring Matt on. But you know, what we do here is very specific. So we don't sell any investments at all. What we do instead is basically hold your retirement account for you. So we provide a service. So we're going to hold that account. You're going to find the investment, and we can hold any private investment, meaning, you know, anything not market-based, like, you know, stocks, bonds, and mutual funds. We can't help you with those. But I'm going to talk about the different investments that we see. And, you know, again, this is what we do every day. So we're very good at this, and we work with people nationwide and even worldwide. So I have some clients that, you know, live in China or Switzerland, and they have a US-based retirement account, and so they're able to, you know, self-direct those accounts, and they reach out to us. They let us know what they want to invest in. We help them make those investments. And so we're located in Largo, Florida, but we also have an Atlanta, Georgia office. That office actually handles marketing and sales. And so here in Largo, Florida, we handle all of our clients' transactions. And in the question box, I see somebody is logged on from Los Angeles, and that's awesome. And I know we have people nationwide, so thank you so much for joining us. I also had a question on the slides and asking if they were available for download. What we'll do is we'll convert them to a PDF, and we'll email them out to everybody on today. So don't worry about that. We'll make sure you get the slides so you don't have to take notes if you don't want to. So Advanta talks and teaches a lot about IRS code 4975 and what you can and can't do within a self-directed IRA. But something that we don't do is give you legal tax or investment advice. So you want to keep that in mind. And, you know, as Matt is kind of going through his materials today for Roth conversions, if you wanted to do a Roth conversion and have Matt help you with that, we are going to require a professional like Matt to sign off on the valuation, because we can't confirm those values for you. That's not what we do here, but it is certainly something that you are able to do with your IRA. So just keep that in mind, that you're going to need a professional like Matt to help you if you're looking to have the values of your assets brought down to a level where doing a Roth conversion makes sense. I always like to sort of go over the types of accounts that you can self-direct, because many times people think that if they don't have a Roth IRA that they can't make those investments into things like real estate and gold and silver and cryptocurrency. And the truth is, if it ends in IRA, it can be self-directed. So I have those accounts up here, and then I have a few other accounts that can be self-directed as well, and that's a solo or individual 401k. Any employer's plan, as long as you are no longer participating in that plan, meaning you've severed ties with that employer, or education savings accounts and health savings accounts. So all of these accounts can be self-directed. And so if you have an old employer plan, a TSP, a 403B, a 401k, any of those can be rolled into an IRA, and now you're ready to do something like purchase real estate or invest into a private equity. So, you know, just let us know if you have an idea for your account. We can talk about how that would work within the rules for self-directed IRAs. I'm going to just touch really quickly on traditional and Roth IRAs, because many of you on this webinar are already very familiar, but others know they have a pre-tax account and they're just not 100% sure what the difference between a traditional and a Roth is. They just know that the Roth might be the better option because it's considered tax-free. So a traditional IRA is a great account. the advantages to it, they do go on and on, meaning that you can roll over an old employer plan directly to a traditional IRA without paying taxes. And so it's very seamless when you make that, do that rollover. It's going to grow tax deferred. So year over year, you're going to have growth and not pay taxes on it. You can contribute to that account. And so if you roll over from an employer plan, but you want to still continue to put money into that account, as long as you have earned income, you can do that. And then, of course, a big one is going to be the tax deduction. Most of the time when you make a contribution to a traditional IRA, you're going to get a tax deduction for doing so. And so many of you, when you do your taxes or you have your CPA help you at the end of the year, they ask you if you made a contribution to a pre-tax account like a traditional IRA or a 401k. And if you did, it's very likely that you're going to get a deduction for doing so. The Roth IRA is going to be the opposite, meaning that it's going to be tax-free. And there are two rules that must be true in order for you to have that Roth IRA tax-free at distribution. The first one is going to be that it has been opened for 5 years. That they call that 5-year aging. So from the time that you open it and make a contribution until the time you're ready to take distributions, normally at retirement age, it has to be open 5 years. And then the second is going to be that you're 59 and a half. So both of those have to be true statements in order for the Roth to be tax-free. But as long as they are, when you take distributions, any growth that you have in that account plus contributions are going to be distributed tax-free. And so that's what makes the Roth IRA such a great account. And so it is possible to go from a traditional or pre-tax account over to a Roth IRA. You're going to have to pay the taxes, and that tax burden is to you, not to the retirement account. So many times people think that when you do a Roth conversion, the Roth IRA, once all that money is moved over, the Roth is going to pay those taxes, or the traditional, and that's just not the case. It's going to be 1099 income to you. And so that's where we bring Matt in, and he's going to be talking about different ways that you can lighten that burden and do that Roth conversion. And the great thing about a Roth conversion is anybody is eligible to do it. So not everybody is eligible to contribute to a Roth IRA because of modified adjusted gross income limits, meaning if you make too much, depending on how you file, you can't contribute directly to the Roth. But if you have a pre-tax account of any kind, you're always eligible to do the Roth IRA. And the biggest question is this the year to do it? Is this the year where maybe you can offset some of those taxes and do that conversion? And so that's what Matt's going to be talking about in just a minute. And before I turn everything over to him, I'm going to just give you an idea of the investments that we see. And so again, just as a reminder, it's all private investments. It's investments of your choosing, so we don't sell anything at all. And so many times we see people investing in real estate. And real estate is actually really the biggest asset class that we hold here at Advanta. We have $1 billion under management, and so that makes up for a lot of investments every day. So we have real estate closings every week, probably every day. I'm not on the transaction side anymore, but probably every day we do a real estate closing where an IRA is either buying or selling a piece of property, and that can be commercial real estate. You can rehab and flip a property. You can buy residential of any kind as long as it's for investment purposes. So meaning that you cannot buy a vacation home or a second home for yourself, but if you're looking to buy a rental property or something that you're simply going to rehab and flip, those things are allowed, and they can be condos, duplexes, single family homes. All of those decisions are completely up to you. We also see a lot of people investing in mortgages. So they might lend to a rehabber who's looking to flip a property, and they maybe don't want to purchase the home and do the flip themselves, but they want to be involved somehow in real estate. And so they lend money, and it could be short-term, long-term, so, less than 3 months, more than a year, 15 years, 30 years. It's completely up to the IRA holder. We also see people do unsecured notes and debenture notes. So anything that you feel comfortable with, and again, we can't give you investment advice, but if you look at that and you feel like, hey, this is the investment I want to do, we're going to help you get it done properly in the name of the IRA. I also see people invest in things like tax liens and assignments, and a great thing about those types of investments, of course, you don't need a ton of money in your retirement account to do those. Other alternatives, and maybe what some would consider very unique, are going to be things like farm animals and movie projects, foreign currency and cryptocurrency, which we're seeing a lot more of now. But then, other things that you may not consider something for a self-directed IRA, but, very normal for us, private stock. So buying stock in a local bank, breweries, restaurants, all of those things are typically considered private stock. We also have people do LLCs for checkbook control. So very simply having a single member LLC where the IRA is the sole member, the IRA holder is the manager, and now you have, just by nature of that strategy, you have checkbook control of the account. And so that's very common here at Advanta too. And then, things like precious metals, oil and gas, again, we don't see those as much, but definitely something you can do with a self-directed IRA. And so with that, I'm going to introduce Matt Chancey. How are you doing today, Matt?
I am all right. How are you doing today, Larissa?
Great. Thank you so much for joining us. I know everybody on is going to really enjoy what you have to say. And again, just as a reminder, go ahead and type your questions into the chat box. I see I have a few. I'm going to look over those, but I'm going to turn control over to Matt.
Awesome. Well, thanks so much. That was a great introduction, and hopefully everyone is either already familiar with Advanta and taking advantage of their services, or after this presentation will be so excited that they can't wait to open a new account with Advanta and put some money in there and make it happen. So let's see what we can do. And like I said, Larissa, when you and I talked before, if you've got some questions or something you think they're relevant, I don't mind you just hitting us right along the way and we'll figure that out.
Okay, sounds good.
All right, so I put a picture of me up there in this slide because I think, what do they say, a picture's worth 1,000 words or something. I don't know if it's worth 1,000 words, but anyway, my name's Matt Chancey. I'm a financial advisor. I'm a certified financial planner. I have been for a long time. I do some work in the media. So there you go, that's me. If you want to look me up on LinkedIn or something like that and connect with me, feel free. We'll go from there. All right, so today's conversation, we want to talk about if we could show you a way to convert your traditional IRA to a Roth IRA and pay the taxes at a discount, would you want to learn more? Now, I know that might sound a little grandiose, like how would we potentially pay taxes at a discount? We're going to walk you through that. The ways I've learned to teach this over the years has been, I teach it in pieces. So, and the first piece of this transaction is we're going to go through and we're going to talk about the value of a Roth conversion and is it something worth doing? So how much of a discount would you need to be interested? If you could discount your tax bill by 20, 40, even 60% or more, would that be enough incentive for you to want to learn how to do this? All right, so like I said, the first piece I want to go to is there value in doing a Roth conversion and paying the taxes now? If we take that as our hypothesis and then we decide that we want to test that, let's see, is a Roth worth it? Is there value in a Roth conversion? All right, let me see if I can get my, oh, there it is. All right, got it. Okay, so we had to make some assumptions in the planning, and I just ran this through some general financial planning software. This is nothing that's overly elaborate. It's just some basic assumptions, but here they are. So we took a couple that's married filing jointly, both at the age of 65, both retired at age 65, with a life expectancy of 20 years to 85. So pretty basic assumptions. There you go. Thanks, Larissa. Yeah, it's not helping me. Yeah, until you do that, it doesn't let me move the screen so much. Okay.
Okay,
so,
I gotcha.
Yeah, it doesn't prompt it on my side. So I appreciate you when you move the mouse, it lets me find it. So, okay, so monthly Social Security benefits of $1,500 of each. That starts at age 66. They both had an income of approximately $50,000 a year. I know some people have more income, some people have less. We're just proving out this thesis. Their expenses are $5,000 a month. We use inflation rate at 3%. And notice that we used a rate of return on assets at only 5%. That is a really low, very conservative assumption. So if you get a better rate of return on your assets than 5%, these numbers are going to look better, not worse. All right, so we're going to consume the assets in a certain order. We're going to spend the client's savings first because that's their liquidity. We're going to spend in the investments in brokerage accounts. Then we're going to look to spend the IRAs, 401ks, or your qualified accounts. And then finally, we'll spend the Roth IRAs. All right, we're keeping it really simple. Now, first, we're going to assume that 100% of the IRA assets, or 100% of the assets are IRA. Client has $1 million. He's got 500,000. She's got 500,000. Nothing complicated so far. All right, and then we run the assumption. So when we run the assumption, we get a Social Security number that says this is their amount of Social Security income. This is their other taxable income. And then you can see the columns that run on Social Security. That's annualized taxes they pay on Social Security, annualized taxes on their ordinary income, their total taxes paid, and then the amount of their Social Security that's actually subject to taxation. So pretty simple calculations. All right, so with 100% of IRA assets, with all those assumptions, total taxes paid are $432,000. Social Security is taxed in all years, and the beneficiary receives $861,000 in change in an IRA that becomes fully taxable. Now, for tax assumptions in here, I'm just going to assume a 40% marginal bracket across the board. It just makes for easy math. I know not everybody is in a 40% marginal bracket. So if you leave $861,000 to a beneficiary and they were to cash in the account on an after-tax basis at a 40% assumption, they're going to lose over $320,000 of that account to taxation. So they're only going to end up with $500-something thousand. Okay, so the second assumption, took the same client, but now what we did is we said his account is an IRA and her account's a Roth. All right, and we ran the simulation again. All right, now you can see Social Security income all years, taxable income stops at age 80. So taxes on Social Security and ordinary income and all those other things stop at age 80. And then you can see how, Social Security is not taxed in those later years. So here's the deal. So $200,000 once again at a 40% marginal bracket, $200,000 tax on a $500,000 conversion at a 40% rate. The remaining lifetime taxes the client would have to pay would be $280,000. So the total taxes paid over their lifetime was $480,000. Taxes paid taxes on Social Security for only 14 years, not all 20. And then the beneficiary receives over $1 million completely tax-free in a Roth IRA, whereas in the last scenario, the beneficiary only received about $500,000 of after-tax money if you paid 40% marginal taxes on the full value of their IRA. So tax-free to your heirs, and imagine the power if you stretch that out. Now I know with the Secure Act, the potential stretch could be limited to 10 years and some other factors. Let's not get in the weeds on that too much. Once again, we're testing if a Roth conversion makes sense mathematically. And then final assumption, we look at both clients with a $500,000 IRA or a Roth in this scenario. So the taxes have already been paid or we did an early conversion. Now we can look, no Social Security taxes, no ordinary income, no capital gain. Social Security is never taxed. Okay, so $400,000 is the amount paid on $1 million of conversion at 40%. Total taxes paid after conversion, none. No taxes on your Social Security, and the beneficiary walks away with $1.5 million tax-free. Remember, this is a 5% assumed rate of return, and this is only a 20-year life expectancy, somebody 65 to 85. So if the clients live longer or they're younger or they get a better rate of return, then the numbers become exponentially greater. Okay, so I kind of, I ran a side-by-side comparison so we would understand this is the taxation every single year. So in the 100% IRA account, it's $432,000 in taxes. The beneficiary receives $861 taxable. The 50% IRA, it's $280 in taxes paid plus $200 on the conversion, which is $480. But then the beneficiary receives over $1 million. And in the last one, there's $400,000 of conversion taxes paid, and the beneficiary receives $1.5 million. So I think this makes a pretty compelling argument for the fact that there is value in a Roth conversion. Now, you have to have the money to pay the tax up front and a lot of other variables. But first and foremost, we wanted to say, does it make sense to reduce or eliminate the participation that the federal government and the IRS has in our qualified accounts? I think, definitively, I think we can say yes to that. There it is. All right. So I try to run a side-by-side. So here's a side-by-side. So 100% IRA, $434,000 in taxes. IRAs, heirs are going to get $861 minus a 40% tax on that would be $517. So if you look at the 50-50 scenario, taxes are $480. The taxes are literally 10% more, but it's 100 200% more to heir, or 100% more to heirs. Instead of 517, it's basically $1,032,000 on an after-tax basis. So it's 100% more to heirs, and then you're talking 200% more. Yeah, I don't know how I messed up that math. I apologize, everybody. I should have got that right. Anyway, instead of $500,000 in the first scenario, you're actually paying less tax at $400,000, and you're leaving 3 times the amount to heirs. So I would argue that a Roth conversion absolutely makes sense in those scenarios. Go back and fix my math on that. All right.
Also, we did have a question pop up. Just because you're assuming, this illustration assumes no withdrawals from the IRA. How does it look if you have a client pulling withdrawals monthly to assist with cash flow?
Sure. I mean, that's not exactly true that we weren't assuming withdrawals from the IRA. If we go back, and I think I can go back. Hold on, I'll try to go back. If you look, this is absolutely assuming withdrawals from the IRA. If you look right here, look, age 65 through 84, that's the taxation on the withdrawal. So the expenses are more than their standard income. So they're having to use assets from the IRA to be able to pay for life expectancy, to pay for their what's going on. This is not completely a deferral. They are absolutely, to maintain lifestyle in this scenario, they are absolutely have to use assets from their IRA. So this is not a complete deferral strategy. This is an income strategy. They do, I went the wrong way. They do need income in this scenario. So I apologize if maybe I wasn't clear on that, but they are absolutely taking income every single year along the way out of their IRA, because their Social Security checks alone were each $1,500, but their monthly expenses started at $5,000 and inflated by 3% per year. So they need $2,000 a month out of their $1 million IRA, which, if you do the math, $2,000 a month annualized is $24,000 a year. $24,000 a year out of $1 million of qualified assets is a 2.4% withdrawal rate, which, if you follow any of the current statistics and logic out there on withdrawal rate theory, they used to would say it was 4%, but now because bonds have a lower yield on it, potentially it's less than 3. I don't know if that's true or not. That's not what this webinar is about, but it's a 2.4% withdrawal rate initially off their portfolio with an annualized inflation adjustment of 3%. So it's not just a growth play. This is an income. This is taking income into account. Hopefully that answers that question. So,
great, thanks, Matt.
Yeah, no problem, no problem. So if you live longer, the benefits are going to be bigger. If your investments do better than 5%, the benefits are going to be bigger. And if you plan to leave the money to your heirs and they stretch it out over the lifetime, the benefits would potentially be bigger. All right, so is a Roth conversion a powerful tax planning tool? I would say that it is, if you know how to do it. The problem, I think, with most people, from a financial advisory standpoint, they're not really financially compensated or incentivized to actually be able to walk their client through a conversion. It's not necessarily profitable for them as a practice. It's just value add for the client. And so I think that's why a lot of advisors don't necessarily do it, or they just don't have any sophistication in the tax space. I don't know the answer. So now ask yourself, what if you could pay those taxes on the conversion and they could do it at a discount? How much more effective ultimately would that be if you could get a discount? So, all right, let's test that. So now that we think a Roth conversion is a good idea, let's talk about how we would do it and get a discount. Okay, so if everybody remembers the stock market crash of 2008 and 2009, I picked kind of the peak and the trough. So in October of 2007, which was the high point of the market, it was at 1549. Of March of 2009, it dropped all the way to 735. That was a 53% drop. Now, if you were a super savvy investor and you believed that, everything that goes down will come back up again over time, if you're strategically diversified in your asset classes and you rebalance accordingly, and you believe that the markets go up more than they go down, then at the bottom of that market in March of 2009 would have been one of the best opportunities ever in your lifetime to convert your IRA to a Roth, because the account value was most likely substantially reduced from where it was at its peak. Diversified portfolio was only down about 28%, but many clients were down 50% or more. So, if you had $1 million account, your $1 million account had dropped in March of 2009 by $500,000. You convert that, you're only paying taxes on the $500,000 of the conversion. That's a 50% savings right there. But let's be practical about that. From a behavioral finance standpoint, I don't know anybody that had enough courage to be able to do that at the bottom of the market. Most people were terrified and thought the world was coming to an end and would have never had the audacity to pull off a Roth conversion at that particular time, even though it would have made a ton of sense. They wouldn't have wanted to deploy their outside capital, their cash, to actually have to pay the tax on the account, which I think would have been prohibitive for most people. So let's assume that we wouldn't have done that, even though it would have been a great opportunity had we have had a crystal ball and could have looked back and known what we know today. But what if we could synthetically reproduce or recreate that type of market environment in our accounts on demand? Okay, so what I say when I mean that, or what I mean when I say that is, so what we're talking about is valuation adjustments. So if for assets that sit in the market, mutual funds, ETFs, stocks, things that are daily liquid that trade, there's a market for those things. There's a bid-ask spread, and you can buy and sell and create liquidity in any particular time on one of those asset classes. So they trade at fair market value. That's exactly what they trade at. So there's not the ability to be able to adjust for valuation or any type of a discount. However, if we take the real estate market per se, which Advanta is a big holder of real estate assets, and we take real estate and we look at valuations, well, what goes into the valuation of real estate? So they look at the location. They look at the size of the property, any improvements that were put into the property, what's its zoning and current usage, could those things be improved? Can you get more dense residential zoning? Can you flip it from residential to commercial? Are there similar properties on the market? They call those comps or comparables, right? The recent transactions involving similar properties, what has sold? What did it actually sell for? Price per square footage? What was its condition? I can compare it to it. And then current demand for such properties on the market. You can look at all these different things, and that's why in a real estate transaction, they have to have a physical appraiser go out, look at the property, take all of their expertise into account to go, here's what I think this current value of this property is. It's not like something that trades on a stock, bond, mutual fund, ticker, where there's another buyer on the other side of the transaction. This, you have to have an actual appraisal, and a lot of that has to do with, lending requirements as well. But let's just focus on how we actually value the property. So you have a professional appraiser go out there and go through their checklist, their methodology of how they determine the value of the asset at hand. All right, so now everything I've got listed on the screen here are prior tax court cases of valuation adjustments that have been argued for and won in tax court with different ranges of valuation discounts applied to them. So, and we don't have to go through them all. That's not what's relevant here, but what's relevant here is there's been valuation adjustments that have been upheld through tax court that have had discounts between 15 and 64% of value. So that is a wide range of potential discount that's eligible for something that you would want to convert. And the amount of taxes you would save on that could be huge. So what are popular alternative investments that could potentially have some of the discounts that apply to them to be eligible for some type of discount? So hedge funds are alternative investments that, private investment funds, private unlisted real estate investment units or REITs. Some people are familiar with REITs, private equity funds, oil and gas partnerships, alternative investments as a whole, as an asset class, Reg Ds, private placements. They don't trade over the market. They tend to be illiquid. You own a fractional interest of it. There's a lot of reasons that they can potentially be discounted with alternative investments. So this isn't for all of your money or all of your assets. These are the type of things that add potential excess returns to a portfolio for the right client, having access to these type of investments, but they also have risk factors to them that allow for discounting and valuation adjustments. So let's look at an example. So we take a Roth conversion with marketable securities and/or cash. So basically stocks, bonds, mutual funds, cash, whatever it is. The value of the IRA is $1 million. There's no appraiser that's going to look at stocks, bonds, cash, whatever. So the fair market value is $1 million. We convert that at an assumed 40% tax bracket. You owe $400,000 in taxes. And now, anytime you do a conversion, it's mathematically prudent to pay for the taxes with the cash from the outside of the account, not from the corpus inside of the account. And so you would have to have that $400,000 cash outside, and then you'd end up with $1 million Roth IRA account. Now let's assume that we can get some kind of a discount on it because the potential asset for the conversion is illiquid and needs third-party independent valuation. So $1 million, 30% discount, fair market value is now 700 grand. Tax on the conversion is 40% of 700 grand, which is $280,000. That doesn't make the value of the underlying asset any less. It makes the valuation on the data conversion actually less. And so there's $120,000 tax savings at a 30% discount. That's decently substantial. I don't know many people that would be upset about saving $120,000 in taxes on their conversion. So if anyone's owned a REIT before, and I am by no means advocating for somebody going out and buying and owning REITs, but if you owned REITs, especially if you purchased them probably prior to the market crash of 2008 and 2009, you probably had some illiquid, non-traded REITs in your account. Hopefully it wasn't a massive position size, that you had paid one price for it on the statement, but it was not worth what you had ultimately paid for it. It was trading at a substantial discount. And these are some examples of some random REITs over the years that have traded at substantial discounts, which would have created opportunities to potentially convert those assets at a discount and save money on the tax on the conversion. Most clients probably just looked at those and complained about them and said, oh my God, I can't believe my account's down so much. They didn't look for the opportunity that presented itself with the valuation being depressed. So how do I do it? So it's not overly complicated, and I say that from somebody I do this all the time. But you must hold your assets at an alternative custodian. You have to have somebody that makes sure that you don't run afoul of what the IRS is ultimately, maintaining the qualified status of the account. You need to use an asset that qualifies for a discount. Net asset value versus fair market value. You have to have something that we can get an independent third-party appraisal on, that we can determine is going to qualify for those things. Now, I get asked this question all the time. There are many people that own a physical piece of real estate inside of their IRA, and can that qualify? Many times, I would say the answer is no, because you're probably going to go out and you're going to get an appraisal on it, but it's you don't necessarily have a lack of like liquidity or minority interest or a fractional interest. It's just a piece of real estate and it appraised for what it appraises for. If you owned it with 3 other parties and the other parties didn't want to sell and you did, lack of marketability might apply, and there's some other strategies to that as well. But anyway, so you need a certified appraisal that'll hold up with the IRS if it ultimately gets challenged. So you have to determine, you had to prove that valuation on the date of the conversion, why it was worth less. You have to time it correctly. So you have to find the right time that you can maximize the value of the discount in relationship to when you actually want to do the Roth conversion. And you have to have the money outside of the account to ultimately pay the tax. You got to have some cash somewhere to pay the tax. All right, I don't know that this is the best slide either. I got to work on a couple of these, but anyway, so I brought back the information from the prior slide. So the first one was the $432,000 of taxes paid. There was no taxes on the conversion, so there was no discount on the conversion, and so $861,000 left to the beneficiary, and the total taxes paid were $432,000. Remember that after-tax amount on the beneficiary at 40% was $517,000. If we want to compare apples to apples to apples. Now, if we have a 50-50 split on our IRA with an early conversion, $280,000 of taxes were ultimately paid. $200,000 of taxes were paid on the conversion. If we did that conversion at a discount of 50%, which I just use 50% as a rule of thumb, you guys saw the math between 15 and 65%. I just use 50 for easy math. then the taxes paid is 100 on the conversion on and 280 in the rest of the lifetime taxes. And so now you paid $380,000 of total taxes in that scenario. And the beneficiary gets just over $1 million on an after-tax basis left in the Roth to stretch. In the final scenario where we're looking at a full Roth account, $400,000 on conversion, if we discount that by 50%, it's $200,000 of taxes on conversion, which leaves the beneficiaries $1.5 million completely tax-free. And so we basically paid the least amount of taxes possible, $200,000 of all scenarios, and left the most to beneficiaries by using a discount. So I would argue that that can ultimately be pretty powerful if used properly. Okay, so I put this chart in here, and I'm sure a ton of people have seen this chart before, and it's not the most recent. This one actually starts at 2013, but it was one of the better charts that I could find. You know, it talks about what historically what are our average tax rates. You know, our average tax rate has been 58. Top marginal tax rate has been 58.61%. Our top marginal tax rate today is 37%, not counting state or net investment income tax. But so we're below the long-term average or the long-term mean for tax rate. So, you know, our government's got a lot of unfunded liabilities. I don't know that the politicians have the political will. I'm not turning this into a political debate. It's not my job. My job is to interpret what they do and find good planning around it, not to try to guess what they think is going to happen. And so I would say that it looks like we're underneath the long-term average for where tax rate should be, which creates a good conversion opportunity. Number two, due to the Tax Cuts and Jobs Act of 2017, and I don't have a slide in here on this, so you're just going to have to listen to me talk, they actually adjusted the brackets down and up. So, and what I mean by that is there are more dollars that can be pushed through lower marginal brackets today than there ever could be. For a married filing jointly couple, the top of the 24% marginal bracket is $315,000. That is a lot of potential income and potential conversion opportunity where somebody could discount an asset and push it through at a 24% marginal bracket. So it creates a real good opportunity to push pretty decent sized conversions. I know there's a lot of people that if you've studied anything on Roth conversions, you've read the bracket bump methodology, which basically says the goal to a Roth conversion is to fill up the top of the marginal bracket that you currently are in. So if you're currently in the 24% bracket, but you have $60,000 left of capacity in that bracket, the goal would be only convert $60,000 a year to stay in that bracket. There's some truth to that, but if you're in a lower bracket than 24%, I would make the argument that with the window that we have due to the Tax Cuts and Jobs Act and the opportunity to discount our assets, that even if I was in something less than a 20% bracket, if I could shove a whole bunch of assets through that 24% bracket in a very short period of time, that I would definitely consider doing it and taking taxes off of the table. That's just me. Maybe I'm a little bit more comfortable with this than the average person. I don't know. Okay, so I kind of have a turnkey process for the way that I do this. I don't kind of have a turnkey process. I do have a turnkey process for the way I do this. So we have investments. I have investments that are private investments that were listed earlier in the presentation, not by name, but by asset class and type, that qualify for discounts between 30 and 70%. I already know they're going to qualify for the discount because it's the way that we use them, it's the way we structure them in client portfolios that helps us accomplish that goal. What can we also help you do? Because these are technically forms of securities and we're not out there trying to find individual assets, we can diversify. So we can use multiple assets in one portfolio, which decreases our risk, which ultimately helps us get the discount we want in a safer, more meaningful way. We set up the timing to make sure that we don't miss any of the timing requirements. The money would be held at the custodian to make sure we meet all the IRS requirements with Advanta. I've done millions of dollars of this stuff. So it's not like something that we're just kind of making up. And you have to be an accredited investor. So if you don't know what a accredited investor is, you can just Google that, but basically it's $1 million of liquid investable assets excluding your primary residence, and or there are some income requirements depending upon if you're single or married. It's not and income and assets, it's or income or assets. So if you're a high income earner, $200,000 as a single individual, $300,000 as a married couple, believe you're going to make it on a go forward basis, or $1 million of liquid investable assets, there you go. It's something that you could qualify for doing this in a turnkey fashion. And then this is me. This is my contact information. So my name's Matt Chancey. That's my email. That's my phone number. You can go to Matt Chancey Live and learn a little bit more about me and the enhanced Roth conversion. There's actually, I believe, a white paper there, which will take you to a little bit of an explainer video or something and kind of walk people through it a little bit. I'm based in Tampa, but I have clients all over the country. I do fly and see some of my clients, depending upon where they're at when I'm getting in that direction. But a lot of my clients I work with using the phone and the internet and technology, kind of like this webinar today. So, and I think that might be it. Yep, just me again. Nobody needs to see that. So, right.
So I did have a question pop up, and we have someone asking, how much cash do you need to do a conversion? And I think maybe more specifically, they might be asking, many of these types of private investments, they do have a minimum, but some of them, the minimums aren't as high as 150,000. Is there somewhere that you draw the line and say, okay, it's, maybe not worth the conversion, or, at this point you have 25,000 invested, you don't necessarily, I mean, is there at some point that you say it may or may not be worth it to go through that process?
No, absolutely. That's a great question. So let me say this first and foremost. I know what I said today is going to sound pretty radical to a lot of people. I am aware of what I say doesn't sound like something that you're not hearing this from other financial people. They don't talk about it. Number one, they probably don't have the products to be able to do it. Number two, they don't have the expertise or the training to understand how it even works. That doesn't mean they're bad at what they do. It just means they haven't developed themselves in this particular nuance of the space. So I say that from this perspective. I get that this is terrifying. I would never recommend that somebody right out of the gate take all of their money and jam it through some kind of a Roth conversion process. I believe this is very much a crawl before you walk before you run type deal. And I would be an advocate for somebody for starting relatively small based on their account size. Now, relatively small on their account size depends on who you're talking to. Sometimes relatively small is $100,000 out of your account. Sometimes relatively small is 3 or 4 million. It just depends on the size of the client. But I have assets that will qualify for discounts. I think right now I would say down to about 50 grand. Maybe I have one at 25,000. Maybe I have one at 50,000. But 100,000 is a good rule of thumb. I can get somebody into almost anything at around 100 grand for the process. But I believe that I do have some inventory of some stuff that would take less in a client account today. So maybe 25, 50, or 100, somewhere in that ballpark. And once again, we'd want to follow kind of a prudent man methodology. Maybe not start with any more than 5% of your overall portfolio allocation, and 5 or 10%. Be very prudent about that, and we could diversify that out and let you feel, see, and experience the process and work through it. And I'll also add this caveat to it. I work with other financial advisors' clients all the time. It doesn't bother me to work with somebody else's clients because I'm not asking for all of the guy's money. I'm only asking for the amount of money that they want to go through this strategic process. The conversion process typically takes about 3 years to get through it, to do it right, between capital placement, converting it the right way, the investment becoming revalued and reliquid. And then you can move it back to your other financial advisor, whoever you work with, if you want. It doesn't hurt my feelings at all. So, I mean, I can do anything that everybody else does, but I found, that I specialize in doing stuff that nobody else really does or understands how to do. And so that's kind of the space I live in.
Okay. And then I had another question, and you kind of mentioned the time frame of 3 years, but let's say that they, discounted the investments, they did the conversion, and then they wanted to actually sell. How quickly can they turn around and sell it? I mean, after everything is said and done.
It's a non-liquid investment, and so it's on a case-by-case basis, depending on which asset I'm actually using or which combination of assets I'm actually using. But 3 years is probably pretty prudent. 3 to 4 years is a pretty consistent amount of time where we would put the money in, we would deploy the capital, we would then get valuation adjustments and discounts. Usually that happens in the second year. That's when we're looking for our conversion opportunity. We're making sure that we're lining that up with the brackets properly. So there's some calculations on the front end to make sure that we're not blowing up into brackets where we shouldn't ultimately be. You know, if somebody's retired or whatever, we're not trying to cause unnecessary taxation on other parts of their portfolio. We want to make sure they've got the liquidity ultimately to be able to pay the tax when the time comes. So year one, we'll deploy the capital. Year two, we'll do the conversion. Year three, we'll get a revaluation at the new enhanced value with the growth in the account. And in that particular scenario, you know, so if you put in put in 100, let's just say it drops down to $50,000 or $60,000 in year two. From a valuation standpoint, we converted it $50,000 or $60,000, and then on the back end in year three, the account liquidates. It might be $125,000 to $150,000 on the backside, and now it's pure IRA, all the taxes washed out, or Roth IRA with all the taxes washed out of the account. So I would say if you're interested in this, for the amount of capital you're going to lock up into it, you need to be comfortable leaving it there for about 3 years.
Okay, that makes sense. I also had somebody ask about your fees, and I just want to mention, you know, Matt's contact information is up here. I would say reach out to him. I'm sure it's on a case-by-case basis, so, you know, I don't want to have him go over, you know, a fee schedule on the webinar, but please go ahead and reach out to him and he can discuss that with you. So I had another question, and this is a great question. Somebody is asking if they're not an accredited investor, if they can still work with you. And I know, just to address a portion of that before I let Matt answer, he was talking specifically about investments that require you to be an accredited investor. So I just want to clarify that. So those investments that he sort of has that turnkey process for, those investments are going to require you to be accredited, and many private investments through like a private equity firm, those are going to have that requirement. So, and then I'll let Matt answer for whether or not he would work with people outside of that sort of the line for accredited.
Sure, Larissa, that's a great answer. I would say this, you know, listen, I don't mind having a conversation with somebody and see if I can point them in the right direction. The reality is I have spoke to many non-accredited investors in this scenario, and there's been a few of them that are really close to the line of being accredited or non-accredited, you know, 800,000, 850, whatever in their accounts. And you know what? You know, with proper management of an asset, I can't work with them to do this when they're non-accredited. But if you're at $850,000, $900,000 of assets and you're still saving some money, putting it away with reasonable growth, you might be an accredited investor within 24 months, right? And so my thought process is every client is different. Some people are way far away from being an accredited investor and never will be, but yet still might have some assets that make sense that they want to look at. I could consult with them and I'll take a phone call and have a conversation. And if I can point them in the right direction and I believe like it'll add value, I might charge them a fee to connect all the dots for them in an expedited kind of way of who they'd want to contact next to see if they can do it. I can't do it from a capital placement standpoint because I don't have a product that will work like that for a non-accredited investor. But if they already own assets that they feel like might work, and once they explain it to me, I feel like they might work, I could probably connect the final dots for them for something reasonable.
Okay, yeah, that makes sense. I don't see any other questions. I'm going to give everybody just another minute to type in any questions before we end the webinar. And I just want to thank you, Matt, for coming on, joining us for this. And we hope to have you back really soon. For those of you that might be interested, although opportunity fund zones don't really work with IRAs necessarily, I actually met Matt when we were both teaching continuing professional education, and he talked about opportunity zones, and it was a great presentation. So definitely check out his website, and you can kind of connect with him for that. I had another question pop up here, Matt. Do all the assets need to be in an IRA? So, you know, of course, for the conversion, yes, but, you know, maybe for the value and taxes paid, you want to go ahead and take that one?
Yeah, not a problem at all. You just have to have accredited investor status. All the money does not have to be in the IRA. So as long as you have a liquid investable net worth, excluding your primary residence, you know, or $1 million, you got to be worth $1 million of investable assets, excluding your home value, to be able to qualify for the process. So if you're You know, if you've got a few $100,000 in an IRA and a wife's got a few $100,000 in an IRA and you got a few $100,000 in cash and you've got some mutual funds and some other stuff, in aggregate, you'll be north of $1 million. You just can't count your home value in that. So absolutely something that's doable. And hey, you know what? I don't even mind. I want to go back. You were talking about the fee question that somebody asked, and I don't mind necessarily addressing that to kind of get it out of the way for people. I am a fiduciary first and foremost. I'm only going to help you try to make the decisions that are right for you and your situation, because I don't need the hassles otherwise. But let me say this, I'm licensed on both sides of the business. Some of these products I can place as a broker, some of these products I can place as an advisor. If you have outside relationships and we're only working with you on a small piece or a small fraction of your business, I can place this product with you in a brokerage type capacity where I don't have fiduciary responsibility over your entire portfolio. It doesn't have to sever or disrupt any of your other relationships. We can work with you, you know, if you're worth $2 million, I can work with you on a couple $100,000 of your portfolio or whatever. If that's what makes sense to you, we built it that way. Now, if we have this conversation, you don't have any other financial people in your life, you want a more comprehensive relationship, you want it looked at holistically, you want me to kind of take into account the other stuff you're doing, which is not mandatory, but if you want that, then we could look at it from an advisory standpoint, and we could potentially charge, you know, we could do fees in that scenario. So it just depends on what fits in every particular scenario. I'm hyper flexible in the way that I ultimately do this stuff. I think too many financial advisors out there in the world are of the opinion that the client has to move all the assets to them right now and work with them exclusively. And I just think that's kind of, I don't think that makes a ton of sense.
Okay. I had another question pop up about land, and I think, Matt, you mentioned that, you know, the discounts don't really necessarily work with tangible real estate.
It can. And I've looked at some crazy scenarios, you know, somebody with a sinkhole on their property and, you know, somebody with a, you know, something next to the property that, you know, a landfill or something that happened. The problem is those things aren't a temporary valuation adjustment. Those are permanent valuation adjustments. The land just isn't worth what it used to be worth. And so you'll get the discount by getting an appraisal. You're just not, and you're never going to get the value to snap back to do what it is you want it to do. And that's where the magic really comes in the process. It's that we can take the valuation of an asset and through, you know, take an asset and through proper techniques of valuation prove that there are discounts that should be applicable, but then we know that that asset later is going to spring back and have a substantially greater value when it's in a tax-free environment. So yes, those other things are, you can value them, but you're probably not going to get the full cycle transaction that you want because you're not going to get that springing value on an after-tax basis.
Okay, that makes sense. And then last question I have here, somebody wants to know if you've ever dealt with a client being audited from the valuation discount.
I have never seen it. There's so much documentation that comes with this. Like in the process, it is pretty darn ironclad. Now, listen, let me say this. If the client is doing a whole bunch of other crazy stuff on their tax return and they're hyper aggressive with everything they do from a tax standpoint, I mean, could it be looked at, I guess, as part of that package in totality? Could be. Have I ever had a client audited because of this? I have not, and I won't say that it could never happen, but I have not, and I have never even actually heard of a client being audited from this. And the reason I say that is because there's some more logic that goes into it behind the scenes that I didn't really have enough time to explain. But for you to justify a discount over valuation means that there's something else. There's usually a benefit on the other side of the equation for somebody else to justify the discount, and we're just on the discount side. We're not on the other side of the equation. So there's two sides that balance out. So basically what I'm trying to say is that if the IRS doesn't allow the discount in the conversion, then there's another thing on the other side of the transaction that they're also not allowing, which would have probably been more favorable or beneficial ultimately for the IRS. So they can't have the good and not maybe the bad at the same time. And so the answer is I have not had a client do it, and I don't anticipate. This doesn't seem like a super risky strategy to me based on all the stuff that I'm familiar with and learned. But I would understand why somebody would ask that question for sure.
Okay. Okay, great. Well, I think that's it. So I just want to thank you so much for joining us for this webinar today. Again, I encourage you guys to reach out to Matt if you have additional questions for him. I will share the slides. I'll turn them into a PDF. I'll email them out, and the recording will also be available. It will go to our YouTube channel, Advanta IRA. Just search for us on YouTube. You'll find it there. But also, it will be emailed out in the next day or so. A lot of times that'll go to spam just because it's a mass email. So check your spam folder if you don't see it in the next day or so, but you will receive the recording. And I thank you so much, Matt.
There you go. Absolutely. Hey, Larissa, thanks so much for the time. And everybody, I hope you appreciated it. I hope you learned a lot from the call.
Thank you. Bye.
Take care.